This is For Advisors by Advisors. I'm your host, Evan J. Mayer, and today we have a special guest, Mr. Joe Conroy. How you doing, Joe?
Appreciate it.
I think this is going to be number 22, 21 to 23, somewhere in there. But you're my first interview of a financial advisor that I don't know already. So interesting enough, or that I haven't been following for significant amounts of time. Joe is a financial advisor. He's an author, and he's the owner of Harford Retirement, without a T. He's an independent financial advisor and affiliated with LPL. And you've been affiliated with LPL since '08, it looks like, but you were with SFG Group prior to starting Harford about, 2 years ago you started Harford?
Yeah, made the breakaway. They were an LPL-based firm. 2020, like kind of in the middle there, was when we started to separate.
Right during the pandemic, basically.
Yeah, what better time? So I rebranded before the breakaway, and it was funny. I like to joke around that we set up this office. We had a ribbon cutting ceremony in March of 2020, and then we shut down the office in March of 2020. So it was a short-lived celebration, and then the reality of the market pullback hit us.
Yeah, I mean, that all together at once. How do I know you, Joe? The only way I know you is that all of a sudden you started showing up on my LinkedIn, and it was similar to Anthony and Keith Wilson and Nick, which I knew Nick already, and I really felt like I knew Anthony from just watching him, and then he introduced me to Keith, and then you came in as like the new guy that was like coming on with these TikTok videos and all this interesting stuff. And I believe I messaged you and I was like, I got to get him on the show. He seems interesting. He seems new, seems innovative, and seems fun. So that's why you're on today. I appreciate you coming in.
I appreciate the offer. I followed along some of the podcasts. It's super interesting to hear from folks that you're connected to and learning new people. But yeah, it's funny. So I've been in the business. I have a knack for picking when the recessions are going to happen because I really got it in 2008. And then I break away and do my own office right before a global pandemic. So if I make a big move, which I don't think I did this year, so I don't know what's going on with the market now, but watch out.
So talk a little bit about SFG. You joined LPL with them. Were they a hybrid or were they duly registered or?
Yeah, I'll go through a little bit further back and kind of tie that in.
Yeah.
I went to Salisbury University, which is on the Eastern Shore of Maryland, and I didn't know what I wanted to do. I was kind of weird in that I knew I wanted to do business. I wanted a 9 to 5-ish job, but I didn't know what kind of business. There's like a million things you do. So I did an internship with a financial advisor that helped my family, and I saw the relationship part of it. And I'm like, that's cool. He's getting hugs from his clients and they're laughing. He's going through numbers. And I'm like, this is great. So I did another internship when I got back. I'm like, that's what I want to do. I want to be a financial advisor. And I didn't know exactly how all the pieces fit together, but I had that kind of goal. So I was lucky at like 20, like that's it. So I did a brief stint at Ameriprise for 2 months. I got my licenses there. And then basically it was kind of like an apprenticeship. There was an advisor that SFG, it was a silo practice. So everybody had their own practice. And it was really branded the way that we were told as advisors is you just kind of plug in, you run your own business the way that you want. And we don't own your clients. You do whatever you want to do.
So almost like a Super OSJ situation.
Yeah, that was kind of the structure. I went and I worked with one advisor. '08 happened. So then I got farmed out and I was working for 2 advisors because revenues were down. It was a great experience because I ended up learning a lot without having to stumble through things myself. I got to see what experienced advisors were doing, what was working, some stuff, what wasn't. And it really confirmed this business for me and that I wanted to do it. So my goal, I don't want to say always was to open up my own shop, but I was interested in it. And the things just lined up in 2020 where it made sense.
And when you left SFG, it's never easy, I would say, but your clients were technically your clients and there was no tug of war or anything going on there?
Yeah.
Okay.
It could have been a smoother process, but I'm happy to be where I am now, and I wouldn't change anything that got me to this point. I'll put it that way.
I talked about this in prior episodes. Where I left, it was technically, the thought was that they were their clients. I left them from the bank channel. So it wasn't similar to that, though, in the concept that it wasn't an overnight kind of breakaway situation, was it?
No, a lot of communication up front. I think it was one of those, they're your clients, you can always take them, but don't. But there were no non-competes or things like that. So
Got it.
I think that Super OSJ model is difficult, right? Because if you've got all these independent advisors and they're all doing whatever they want to do, what's that glue holding everybody together? What firm value does that have?
Mm-hmm.
And it's not just where it came from. I see it all over the place where it's like, well, it's just easier to do split revenue, right? We'll just do a split code. Like, come over here, like I got a client, I can't take any more clients, so I'll just start doing these split codes with everybody. And then you get this big rat's nest. And to untangle that, because at some point it's got to be untangled. People retire, people pass away, people leave to go do different things. What do you do with that? It's kind of a mess. So the more you get in and the more it's all tangled up like that, I feel like you're just kind of kicking that can down the road. To people have different expectations for what the exit looks like, but no one communicates it on the front end.
Yeah, and I think it's different dependent upon where you're at. And in your situation, I think it was that way. I had a situation which was there was no my clients were my clients, and that was actually segregated out and written in contract, and it made life a lot simpler.
Right.
But yeah, you're right. So if it's not set up properly, then it's a big cluster. And if it is, it can actually align well if people, are sharing the same resources or needs per se.
Clients do the front work, do the legwork up front, have the tough conversations in the beginning. So that way everybody knows what the deal is and have it written down, like legal contracts or not, so that there's no expectation. I'm not just talking about where it came from. This is just a general, because I'll have different advisors I talk to about how to set up a group.
Yep.
And so what we've got at Hartford, without a T, we work as a group. So there's the silo, like I came from, and then there's the ensemble where it's like the law firm, probably doctors' practices, like accounting firms, where clients can do whatever they want to do. They're not property of anything, but the relationships, if they continue to work with the company,
Yep.
the company, right? So then you've got something that has more enduring value. You take out one advisor, the thing continues to go. And that's what we're building here. And in just a couple of years, and I didn't come up in this model, it for me, and it's not right for every advisor, it's been fantastic.
Talk briefly about that. So it looks like you have about 3 advisors and 2 operational support members. When you made the move in 2020, was it just you and one other? Was it this whole group of 5? Was that going to be a focus as recruitment going forward?
Yeah, it's funny. I was looking to join a more established advisor's practice. So I'm young, I look young. I don't know that I could say that as much anymore, but back then I could. 3 kids will change you. But I was looking to be a junior partner, and none of the advisors that I talked to really had an interest. They'd been Lone Rangers, and that's the way they wanted to keep it. So it was tough. So I had to try to source clients and go at it that way. So what I'm trying to do is create more of a career path, right? So invest in folks earlier in their careers and then show them the path towards growth within this company. So you can go as far as you want to. If you want to be admin and stay that way, you can. If you want to be like a junior advisor or more of a senior advisor, or even get up to partnership level, and we've all got a seat at the table, here's what you need to do in order to get to that point. I don't want to be the only person that owns this thing forever. So it's interesting. I'm working on my succession plan, but I'm in my 30s, right? You hear these horror stories about advisors and they're 65 and he or she wakes up and, oh man, I got to retire at some point. And then you're scrambling to figure it out after the fact. So,
yeah, I think planning ahead is what you do for clients every day. There's no reason you shouldn't do it for your business either. So, yeah, I don't see anything wrong with that. In some aspects, this is a new venture for you, and you're building this out and going where you're going. And obviously, you made the move during the pandemic, which you could consider to be tough. But at the end of the day, at least you were leaving an independent firm to open up your own independent firm. So it didn't make the move nearly as tough as it could have been. And
at the end of the day, the clients are clients of the advisor.
Yep.
So replace a couple of letters with a couple of different letters that really they didn't even notice. It was, here's a different ADV. What's an ADV?
Account numbers didn't need to change, didn't need to repaper, and none of that stuff. So that makes life easier. Brain is a different beast. But yeah, you're right. I went independent, opened up my own company and my own practice in August of 19, and we just renamed ourselves in February. That was an easy move. We were talking about names earlier. You're like the new TikTok guy. You're on LinkedIn, and it looks like you're putting in a lot of effort or a lot of work. And as I was saying to Keith and Anthony, if you're enjoying it, there's not a lot of effort or a lot of work. It's actually a lot of fun. And yours is a little bit more focused on quick clips, which is what keeps people's attention supposedly in these algorithms. Have you seen any success from what you're doing so far?
Yeah, I got like a shotgun approach. I'll just put a bunch of stuff out there. I have no strategy when it comes to my content creation. If something seems interesting to me, I'll try it out. But it was funny. I think it was around the same time that Keith and Anthony really started ramping up video stuff. I remember Mike, who's still with me, we were sitting in the old office and I was like, Mike, I don't know. I think we got to do video. I don't know why. Like, people say you got to do video. I'm like, maybe we should do it. I think it'd be okay. And it wasn't. We were awful. I was so bad. I'm not comfortable with it. It's really awkward. And I get why most advisors don't do it. It's because it makes you uncomfortable. But that's really where you like grow the most, right? So we started doing it probably towards the end of 2019, which really ended up being a great, not that I had the foresight of a pandemic, but going into 2020, we're all stuck at home and we're looking at our phones way more than we were before. So at least I could do a lot of the learning curve before people were really online as much as they are then and now. But we'll do videos. So we did videos, big analogy guy. I tell stories. And I think from a client and potential new client point of view, you give the advisor a test drive, right? Because what you see in these videos, and just to be clear, like on the TikToks, I don't dance. I'm not into that. But
Not yet. Not yet.
not yet. Don't never say never. You get an idea of my personality, and I don't script anything. I might have a couple talking points, but I've never done a script. It's very, as I try to be as natural as I can be, and that's our approach to content.
It's
And
fun. It's fun. I've watched a lot of your stuff, and it's quick and it's entertaining and it's fun. And glad you're enjoying it. Talk a little bit about niches. So some advisors, specifically the ones that are online, are focused on niches. My model or business has always just been on relationships and gathering those relationships, and I really never focused on specific paths or niches. And being in the bank channel, I was able to build up a nice size book of business where I don't have to necessarily focus on niches. But when you're starting a new company, sometimes you do. Talk a little bit about the niches you're focused on.
I'm the anti-niche guy.
Okay.
So I would say if I had to say what niche, it's probably like personality type, like a value system, the way that I'll give you an example. So we had a potential new client come in today, and we're terrible salespeople. So I tell everybody up front, I'm just not very good at like sales. And towards the end, we're like, look, go home, think about it. If you want to talk to a recent widow, if you want to go talk to your like son-in-law or daughter, whatever, we're here for you. We'll check in if we haven't heard from you for a while. Like, nah, I think we're good. She said, I knew when I walked in and you guys weren't all suit and tied up, and it was more of a comfortable place, which is a little bit more our style, come as you are, more like homey type, that this was going to be a good thing. And then we went through all of it, and she's like, it was. So we're looking for like a personality type, people who value family. They work because they like it, but they want the option to not at some point. If you want like the Wall Street three-piece suit and you want us to talk over your head and make it seem like super confusing, we don't do that. We're not good at that. And some people do want that. That's just not kind of where we fit.
Got it.
But no, it's funny. You talk to these industry professionals, it's like you have to have such a hyper-focused niche. I'm only going to work with neurosurgeons between the age of 45 and 55. But what if there's really good people you could work with that don't fit that super specific category?
Yeah, I fully agree with you too. I watch some of these podcasts, or I've listened to some of these podcasts, and like I think Michael Kitsis is his name. He's so big into talking specific niches, and I never had a niche because at the end of the day, people need financial planning, and if they're a good personality, they're a good fit. And I say to clients as they come in on an initial meeting, it's there is no initial thing. It's more of a conversation. It's more of, are they okay to go through financial planning where I can get to know them and truly help them, or are they looking to be sold? And I agree with you. The people that are looking to be sold are going to be issues for financial planners if you bring them on and that's their concept. So
yeah, I had a guy one time, this happened a couple of times, but this one stands out. Came in, he's like, well, Jim, I'm like, it's Joe, but all right. He's like, anyway, why do I need a financial advisor? And I looked at it, I was like, I don't know, maybe you don't. It's like, what? No, you're supposed to give me the reasons why I do. I was like, but I don't know if you do. What are you expecting? I'm going to time the market for you, or I've got access to whatever IPOs that you can. I'm like, I don't know what the expectations are. And if they're not something I can realistically deliver, then I'm probably not the guy for you.
Yeah, that's the way to handle that, right?
Yeah. And it
um,
was, yeah, and that's the thing. I saw my business change the more comfortable I got with, I don't need it. I'm only going to work with people that are a good fit. I'm not going to try to be all things to all people. We got to be aligned in the beginning, because when the market turns over, which it does on a regular basis, it kind of stresses things, and we got to be on the same page. But I don't want to just say anything to get the business and then disappoint you later. I'm not going to do that.
yeah, it's better. Yeah, and again, you're not going to bet 100 on that too. You're going to have people that you think are a good fit, and they think you're a good fit, and then the market does turn, and then you're like, you don't remember our conversations? Where were we headed here? You're right. Taking care of that on the front end makes sense. So you're working with a lot of younger advisors, and you're potentially bringing them in and helping to escalate them in their paths. What's the number one thing, number one, two, or three things that you try to instill in these younger advisors that you're bringing in?
Anti-sales, I say, when I came up, everybody says you got to take whatever you can get in the beginning. I had one time, I met with this family friend. The guy answered, I'm in a meeting, so I'm in a suit. I'm like 20 something years old, totally green. And he's married, family, super nice guy, but he just answers the door and he's in his boxers. That's it. I should have just been like, you know what, this probably isn't going to work. I'm just going to go back to my car. But I did it. I did the meeting, and and he dictated like what he wanted. Red flags everywhere. And I just like, I can fix them. We can train the client. I'm like, no, the guy is who he is. He's a nice guy, but he's just not like a good fit for me. And the boxers were probably, for most people, would be like, yeah, I'm out of here. But for whatever reason,
It's kind of like college too, in a way. At 18, 19, 20, we go to college and we're not interested necessarily. We're just trying to get the degree in whatever we're trying to get the degree in. I actually went back to school and finished in my early 30s. And I was so excited. Now I'm sitting around with 19 and 20-year-olds, but I truly enjoyed the educational process and learning things that I didn't already know. And the funny thing is that when we're financial advisors starting out, we feel like we need to take everybody. And in some cases you do, because you need money and you got to put money on the table, and it's really tough. And you wonder why some people didn't want to work with you when you were 25 or 30. Well, you weren't very good compared to what you are today. I said this in a prior podcast. And I'm 42, you're 37. We're 5 years old. We're somewhat close in age. I think you probably do the same thing. Tell me if I'm wrong, but you look back at every year and you go, I'm a lot better of an advisor than I was the year prior.
right? Yeah, you have to. You learn from it. So the younger guys in our office, I tell them, like, if there's red flags, don't work with those people. You can say no and don't take everything. And the compensation structure, I think, in this business is difficult because it is, for a lot of bigger firms, it's sales. At the bank, you probably had quotas and numbers you had to hit. And it's like, Ameriprise, you had to hit so many rolling 12-month GDC, whatever. So here, I'm like, everybody's going to get paid. And it's going to be, there's compensation that's variable based on net new assets. So
Amen.
yeah, be careful. If you bring in a client, try to vet them out so that you're not bringing in some problem child that's going to be out the door and screw up the next bonus for you. I don't know, for whatever reason, it slows down or anything. It's not like you're afraid that you're not going to make your mortgage payment. So there's incentive that I think aligns with rewarding getting clients that are a good fit and not
Joe,
doing
without
commitments.
going to exact numbers or specifics, because I think
Yeah.
people are interested. There's a lot of advisors in here that are looking to grow and bring on new advisors. Can you talk a little bit about the compensation situation? Because that sounds interesting and might be good for our audience.
Yeah. So I built this thing to be able to not be like the only owner of it. The goal is partnership for everybody. So there's three layers. There's the base compensation. So your basic needs are met, right? And then there's a variable compensation, some bonuses that are structured based on things that you actually have control over, not based on firm profitability, because they don't have any control over how much money I spend on whatever it is that we're doing. So based on the specific job. So advisors, net new assets, admin, accuracy of work, accomplishing certain certifications, things like that. And then the third component, just like any kind of a law firm or big group like that, profit distributions to the ownership pool. So there's certain metrics that you know ahead of time. If you do this and this, you have a chance to buy in. Nothing's given away. Nothing was given to me. I had to work or buy whatever I've got. So that's the path. And nobody has to take it, right? So if you don't want to be a partner and have the responsibilities of that, you don't have to. But that's the way we set it up, that three tiers.
Three-tier system. Very cool. So far, so good. They're buying into the concept and it's working.
Yeah, open book. We talk about it. I've done a few practice acquisitions, 3, and I've learned through experiences that the only deals I want to be a part of are win-wins. So it's got to be good for me for a practice acquisition. It's got to be good for the advisor, and it's got to have a good fit for clients, right? If we can't get those 3 things, then something's going to go off and somebody's going to be upset later on. Me, them, I don't want any of that.
Yeah.
So same thing with employees. And I try to create the system that I was looking for when I was in my early 20s and trying to figure out my way in this business. I didn't want to be, I kind of like defaulted into entrepreneurship because I couldn't find what I was looking for. So then I had to build it.
Yeah.
Now, what I've learned is that I love building it. I have a great passion for it. And I think it's a lot of fun. Not all the time, but most of the time, the good outweighs the bad. But that's how I structure the system is I'm building what I really was looking for early on.
I love it. And a unique twist to something. And there are quotas at most places. And the bank channel, it wasn't necessarily a quota, but the more revenue you produced, the better your manager's numbers looked and the better branches you got, right? The better situations that you got. I remember when I went from early in my career in '08 from straight commission guy to full fee-based guy. That took a while for management to see. I had to train them to look at AUM and not profitability. So it's a very cool thing you're building there. And I think it's an interesting thing. And it's a way to build the practice the right way and bring on the right kind of clients. If you're like me, your paths change every 6 months. You have a different thought on where you want to go. But if you're looking 5 years down the road, 10 years down the road, what's Hartford look like at that point?
Great question. I would have thought that I would have gotten the level of business where I'm at, like when I'm 60. So I'm in like bonus innings here, but I'm having a lot of fun with it. I want to be shifting, be an advisor and support, but be a little bit more of a business owner, business development, marketing, brand awareness. The path that I've taken is get really good at knowing what paperwork to give to clients. Then what do you actually do with these clients? And that then generates the paperwork. And then it was like, how do you find enough clients so that you can actually like eat, right? And I was lucky because I was early and ramen was okay back then. So I didn't really need a whole lot. And my now wife, she's a teacher, so she had steady incomes. It'd be tough to do that later on in life. But learn the marketing, right? And I really enjoy the marketing. It's for the content stuff. I'd like to think I'm creative. And then the next iteration is building a business. And we're there now, it's building a team. And that's something that I'm finding super rewarding. And I see the guys here and they're doing great things. And, you know, I get such an immense sense of satisfaction out of seeing their successes. So I want to be more of the leadership, mentorship type role. But I don't want to do it with like online coaching or anything. There's so many of those around. There's some good ones, but there's a lot. I want to do that internally. You know, build this team and support everybody, be everybody's like cheerleader and see how far they can take it.
Love it. As far as asset allocation, investment analysis, are you mostly using SMAs, UMAs? Are you outsourcing, or do you is everything discretion? How do you manage your portfolios currently?
So it's a little bit of a mix. We'll do total customization if the clients prefer that or tax needs warrants it. But the rest of it, we fall into models.
Okay.
So LPL, we've got a platform where basically you can create your own portfolios and then they do all the implementation.
Okay.
As I was ramping up, I was doing all the rebalancing and all the research myself. And I felt like each portfolio was a little bit different. And I'm like, this isn't scalable. And quite frankly, like it leaves too much open for inconsistencies. So we figure let's just get a couple of models, research them, and that is something that we can spread over more households than trying to be unique to each individual portfolio that we get.
Is it discretion managed or non-discretion?
Yeah, we're 90+% discretionary.
Discretionary. Is it mostly individual securities or more in the packaged funds or ETFs or things along those lines?
Funds and ETFs, a bulk of it. It depends with everything. It's whatever we feel fits that client and what gets them on the best path. But I see in times like this a lot of value for doing individuals. If I own MFS Value, just to throw something out there, but a client sees their statements down, they look at their portfolio, it's MFS Value, Fidelity, blah, 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 Vanguard, this and that. They're like, I don't know what this stuff is. It's just down, and I don't like that.
Yeah.
But if you've got individual names in there and you can say, okay, well, I own Apple, Amazon, Microsoft, JP Morgan, Home Depot. It's like, well, I know what that is, and I don't like the statement number, but they'll come back. They're not going to go out of business. So that's kind of helping just reinforce the behavioral aspect of it. It's having a little bit more transparency into actually what they own.
Yeah, so I'll piggyback on that. Our portfolios are 100% discretionary, and the stocks we do are all individual equities and individual bonds too. And that's important also because these 60-40 models are getting killed in the fund space. But not to bash anybody doing anything else, but it does help with consistency and clients knowing what they own, seeing the maturities, seeing the value, saying to the client, like, yeah, I know McDonald's is down 20%, but people are still eating cheeseburgers next year.
I have a restaurant near my house and I see the drive-through line around the window. So they're still selling burgers, right?
They're still doing it, right? So for behavioral finance, I think it's a lot harder to manage and you should be skillful. All disclaimers out there, you better know what you're doing. If you do know what you're doing, it's an easier conversation with the client for sure. Joe, this is always my closing question, but you're driving home after hanging up this call, and there was one thing you wanted to really express on the call that you thought would be helpful for financial advisors. What would that be?
But geared towards financial advisors.
This whole show's geared for it. I mean, hopefully.
Yeah, I don't know. I would say it's tough when you first get started. For younger advisors, am I going to get over that hump? Am I going to make it? And there's no guarantees of anything, but if you put the client's best interest ahead of everything else, then you're driving home at the end of the day, you feel good about what you did, and then you're energized to do it the next day. Now, you might get your head bashed in a couple of times, but the good's going to outweigh the bad. And I need to lay my head down at night and know that I'm doing the absolute best I know to do for my clients. And I think that's the superpower. ETFs, mutual funds, those are different ways to get to the same point, but you got to do what you believe is in the best interest of the client. And that energy will give you fuel to keep going, and it just makes everything easier. It's obvious, but we can get away from that sometimes.
Joe, I got to tell you, I'm pretty good at reading people, and I think top advisors are, and you get it. You get it, and your personality is phenomenal, and the way that you just explained how you talk to clients and what you do, and even the path that you're doing for these junior advisors, I think is phenomenal. I didn't know anything about you prior, and I like that. I like kind of getting to know somebody on this podcast, and I'm excited and happy that you're in our business, because these are the type of situations where if 9 out of 10 advisors were like Joe, our industry would have a really good reputation, and it should. So thanks for being you.
I think it's getting there, Evan. I think I want to see us at the same professional level as CPAs and things like that. I mean, if a CPA tells a client to cut their left arm off, that client's going to say, all right, the right one too? Or, I mean, they just do whatever they say because there's that trust. And good advisors do such good work. It's a shame that sometimes it's drowned out by the ones that aren't so good, which are few. There's more good ones than bad ones.
It's funny, now that I'm independent, I'm on LinkedIn, you notice them more when you're in different channels and you can't use social media. It becomes, you don't see the good advisors per se. You just see who's around you. So, Joe, awesome to have you on. How can anybody, if they want to get a hold of you, reach you?
Yeah, so connect on LinkedIn. We're on YouTube, Hartford Retirement. We've got our own YouTube channel. We're on Facebook. Send me an email. Go to our website, hartfordretirement.com. I'm happy to help and connect with other advisors. We can all make ourselves better and learn from each other.
100%. And those of you that are out there, follow Joe. I think he's got some interesting content. He does it in a fun way. He does it in a short way. It's interesting. It's entertaining. And thanks again, Joe, for being on. You guys know how to get a hold of me, and I look forward to the next time I see you. Thanks.
Thanks, Evan.